So, basically, what is compound growth?
Compound growth is one of the most important ideas in investing. It happens when growth begins to generate even more growth. In simple terms, money grows, and then future growth is earned on both the original money and the growth that has already been generated. For example, imagine someone invests $1,000. If the investment grows by 10% during the first year, it becomes worth $1,100. The following year, the growth is no longer calculated on the original $1,000. It is calculated on $1,100. If the investment grows by another 10%, it becomes worth $1,210. Notice what happened. The second year's growth was larger than the first year's growth, even though the growth rate stayed exactly the same. This happened because the investment was growing on a larger amount of money. After 5 years, if the investment continues growing at the same 10% annual rate, the investment would be worth about $1,611. After 20 years, the same investment would be worth about $6,728. The investment did not simply grow by the same dollar amount each year. If it had gained only $100 every year, it would be worth only about $3,000 after 20 years. Instead, each year's growth became part of the investment itself. The following year's growth was then calculated on both the original money and all the previous growth. That is the key idea behind compound growth. If the original $1,000 had simply been kept as cash and left sitting in a drawer for 20 years, it would still be worth only $1,000. The money would not have generated any additional growth by itself. In fact, because of inflation, it would likely buy much less after 20 years than it could buy today. But through compound growth, that same $1,000 grew to about $6,728. Compound growth is often compared to a snowball rolling downhill. As the snowball grows larger, it collects even more snow. The larger it becomes, the faster it can grow. Compound growth works in a similar way. Compound growth can happen through rising investment values. It can also happen when dividends are reinvested. Instead of spending the dividend, an investor may use it to buy more investments. Those new investments may generate growth as well, and over time, they may begin generating their own growth too. Of course, compound growth is not guaranteed. Investments can go down as well as up. Some years may produce strong growth, while other years may produce little growth or even losses. Compound growth works best when investors give their investments time and remain patient through normal market ups and downs. So basically, compound growth may seem slow at first, but over longer periods of time, it can become one of the most powerful forces in investing.